Welcome to Day 25 of Future Business School's Daily MBA series. Today, we're diving into venture capital and private equity, two critical sources of funding for businesses at different stages of their growth. We'll explore how these funding mechanisms work, how they are valued, and review some illustrative case studies. What is venture capital and private equity? Venture capital, or VC, and private equity, or PE, are types of investment that provide funding to companies, but they target different stages of a company's life cycle and have distinct characteristics. Venture capital focuses on funding early-stage companies with high growth potential, but also higher risk. Venture capitalists provide capital in exchange for equity and often take an active role in managing the company. Private equity invests in more mature companies through buyouts, aiming to improve profitability and then sell the company for a return. Private equity firms often acquire controlling stakes and implement strategic changes to enhance value. Venture capital. Venture capital is crucial for startups and early-stage companies looking to scale rapidly. Here's a closer look at how it works. Funding stages. Seed stage. Initial funding to develop an idea or product. Early stage. Funding to help a company grow and enter the market. Growth stage. Funding for scaling operations, expanding market reach, or product development. Key concepts. Equity financing. Venture capitalists provide funding in exchange for ownership shares in the company. Valuation. Determining the value of a startup, often through methods like the venture capital method or scorecard valuation method. Venture capital method. Valuation equals estimated exit. Value divided by 1 plus expected rate of return raised to the power of n. Where estimated exit value is the projected sale price or IPO value. Expected rate of return is the target return on investment. N is the number of years until exit. Term sheets. These are documents outlining the terms of the investment, including the amount of investment, valuation, equity stake, and control rights. For example, Uber Technologies Inc. received early-stage venture capital funding from firms like Benchmark Capital. This funding allowed Uber to scale its ride-sharing platform globally, eventually leading to a successful IPO. Real-world example. Airbnb's funding journey. Airbnb started as a small startup with venture capital backing. Early investors like Sequoia Capital and Andreessen Horowitz provided funding during crucial growth phases, helping Airbnb expand from a small rental service into a global leader in the hospitality industry. Private equity involves investing in more established companies. Here's an overview of how private equity operates. Types of private equity investments. Buyouts involve acquiring a company to gain control and improve its performance. Growth capital is about investing in mature companies to expand operations or enter new markets. Distressed assets focus on investing in companies facing financial difficulties with the aim of turning them around. Key concepts. Valuation methods commonly include discounted cash flow, comparable company analysis, and precedent transactions. Let's look at a DCF example. Valuation equals future cash flows divided by 1, plus the discount rate raised to the power of n. Where future cash flows are the projected cash inflows from the business, the discount rate is the rate used to discount future cash flows, and n is the time period. Leveraged buyouts, or LBOs, involve using borrowed funds to acquire a company, where the target company's cash flow is used to repay the debt. Exit strategies could include selling the company through a public offering, private sale, or merger. For example, Dell Technologies underwent a leveraged buyout by Silver Lake Partners and Michael Dell in 2013. The buyout allowed Dell to refocus on its core business and return to the public market with improved performance. Real-world example. The Blackstone Group. Blackstone is a leading private equity firm known for its large-scale buyouts and investments. Its acquisition of Hilton Worldwide in 2007 and subsequent efforts to enhance Hilton's operations led to a highly successful public offering in 2013. Challenges and considerations. Venture capital. High risk. Investing in early-stage startups can be risky with a high rate of failure. Control and influence. Venture capitalists often require significant influence over company decisions. Private equity management expertise requires effective management and strategic improvements to realize value. Regulatory issues. Buyouts and large investments may face regulatory scrutiny. Conclusion and key takeaways. Understanding venture capital and private equity is crucial for both entrepreneurs seeking funding and investors looking to deploy capital. Here are the key takeaways. Venture capital focuses on high-growth startups with potential for substantial returns. Involves stages from seed funding to growth capital and includes valuation methods and term sheets. Private equity targets established companies for buyouts, growth investments, or turnaround situations. Involves valuation methods, leveraged buyouts, and exit strategies. Real-world impact. Both VC and PE can significantly influence company growth, operations, and strategic direction, as evidenced by companies like Airbnb and Dell Technologies. Thank you for joining us on this exploration of venture capital and private equity. If you found this video helpful, please like, share, and subscribe to Future Business School for more valuable insights. Tomorrow, we'll cover risk management and hedging. See you then.